Preparing for accounting at Dominion Energy interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What makes utility accounting different from accounting in most other industries? Utility accounting is shaped by regulation as much as by commercial activity. Dominion Energy invests heavily in generation, transmission, distribution, and gas infrastructure, so PP&E and depreciation are significant. Regulators determine which costs can be recovered from customers and when, creating regulatory assets or liabilities under ASC 980. Revenue may also include approved rate mechanisms, such as fuel adjustments. Therefore, I would analyze both U.S. generally accepted accounting principles requirements and the relevant regulatory orders before concluding on an accounting treatment. While answering, focus on regulated operations, long-lived infrastructure, rate recovery, predictable demand, capital intensity, regulatory accounting, depreciation, and the relationship between financial reporting and approved customer rates. Question 2. What is regulatory accounting under ASC 980, and when can a utility record a regulatory asset? A regulatory asset records a cost incurred today when an authorized regulator has created a reasonable expectation that customers will reimburse it through future rates. For example, approved storm restoration costs may be deferred rather than expensed immediately if recovery is probable. I would verify the regulatory order, assess probability of recovery, document the expected recovery period, and amortize the balance as rates collect it. If recovery becomes unlikely, the asset must be written down. Make sure to cover probable future recovery, rate-setting authority, timing differences, qualifying costs, documentation, amortization, and the requirement to reassess recoverability as regulatory conditions change. Question 3. How would you explain a regulatory liability to a non-accountant? A regulatory liability represents amounts collected from customers or benefits received before the utility has fulfilled the related obligation. Suppose rates include recovery for a future decommissioning cost or customers are overcharged through a formula. The utility may need to defer that amount and return it through lower future rates or refunds. Unlike a normal payable, the balance is governed by the regulator's recovery or refund mechanism and is released as the approved obligation is satisfied. In your answer, talk about amounts collected before related costs occur, customer benefit, future rate reductions or refunds, recognition timing, and the distinction between regulatory liabilities and ordinary operating liabilities. Question 4. How would you account for property, plant, and equipment at Dominion Energy? I would capitalize expenditures that create or enhance future economic benefits, including generation equipment, pipelines, substations, and distribution assets. Costs remain in construction work in progress until the asset is ready for intended use, then move to the appropriate PP&E class and begin depreciation. I would distinguish capital costs from repairs and maintenance, validate overhead allocations, track retirements, and reconcile subledgers to the general ledger. Accurate placed-in-service dates are especially important for depreciation and rate base reporting. Be sure to mention capitalization criteria, construction work in progress, placed-in-service dates, overhead allocation, componentization, depreciation, retirements, and the importance of detailed asset records. Question 5. When does depreciation begin for a utility asset? Depreciation generally begins when an asset is placed in service, meaning it is substantially complete and available for its intended use, not necessarily when it reaches full operating capacity. Before that point, qualifying costs remain in construction work in progress. I would confirm the placed in service date, useful life, salvage value, and approved depreciation method. Starting too early understates earnings and asset balances, while starting too late overstates them and can distort rate base calculations. Focus on the asset being available for intended use, construction work in progress, regulatory treatment, estimated useful life, salvage value, depreciation method, and the effect on earnings and rate recovery. Question 6. How would you distinguish capital expenditures from repairs and maintenance? I classify spending based on whether it creates future benefits beyond routine maintenance. Replacing a small valve with an equivalent part is normally repair expense, while upgrading a pipeline segment to increase capacity or extend useful life is generally capitalizable. I would review the work order, engineering description, project authorization, and company policy, then test whether the expenditure meets capitalization criteria. Consistent treatment matters because classification affects PP&E, depreciation, operating expense, earnings, and regulatory recovery. Make sure to cover future benefits, extending useful life, increasing capacity or efficiency, routine upkeep, materiality, capitalization policy, work orders, and consistency across similar projects. Question 7. What is the difference between construction work in progress and completed utility plant? Construction work in progress captures qualifying costs for an asset that is still being built, including materials, labor, contractor charges, and potentially capitalized financing-related amounts. It is not normally depreciated because the asset is unavailable for service. Once construction is substantially complete, the balance transfers to completed plant, and depreciation begins. I would also consider whether the regulator allows CWIP or related financing costs in rate base, because that affects both reporting and customer rates. In your answer, explain the temporary nature of CWIP, accumulated construction costs, allowance for funds used during construction, placed in service transfer, depreciation, and potential rate-based treatment. Question 8. How would you account for an asset retirement obligation at a regulated utility? An asset retirement obligation is recognized when a present legal obligation exists to retire or remediate a long-lived asset and the obligation can be reasonably estimated. I would record the present value of expected retirement costs, increase the related asset's carrying amount, depreciate that addition, and accrete the liability over time. I would update assumptions for timing, inflation, and costs. At Dominion, I would also assess whether regulators permit recovery through rates and how that affects presentation. Cover legal or constructive obligations, present value measurement, initial liability and asset, accretion, depreciation, changes in estimates, decommissioning, and possible regulatory recovery. Question 9. How do regulatory assets and liabilities affect Dominion Energy's financial statements? Regulatory assets increase assets and defer expense recognition until customers provide recovery through rates. Regulatory liabilities increase liabilities and defer revenue or benefits until the utility refunds or passes them to customers. Their amortization affects operating income, while the underlying cash payment or collection may have occurred earlier. I would reconcile each balance to regulatory orders, explain current and non-current classification, evaluate recoverability, and ensure disclosures describe significant balances, amortization, and remaining recovery periods. While answering, connect the balances to the balance sheet, amortization to earnings, cash flow classification, rate recovery, disclosures, and the risk that changes in regulation can create impairment or volatility. Question 10. How would you account for storm restoration costs? I would first identify the nature of the storm costs. Routine restoration labor and emergency response are generally expenses, while replacement or improvement of qualifying infrastructure may be capitalized. If a regulator authorizes future recovery and that recovery is probable, eligible costs may be recorded as a regulatory asset instead of immediately expensed. I would separately track insurance reimbursements, customer collections, and capital projects, then amortize the regulatory asset according to the approved rate plan. Be sure to mention emergency expenditures, expense recognition, regulatory authorization, probable recovery, deferral, insurance proceeds, amortization, and the need to separate capital restoration from operating costs. Question 11. How are revenues recognized for a regulated electric or gas utility? Utility revenue is primarily recognized as electricity or gas is delivered to customers under approved tariffs. Billed revenue comes from meter data, while unbilled revenue estimates consumption between the last meter reading and period end. I would validate volumes, approved rates, weather impacts, and the estimation methodology, then reconcile billing system activity to the general ledger. I would also evaluate alternative revenue mechanisms, refunds, and collectibility before finalizing the period-end revenue accrual. Focus on customer consumption, meter readings, estimated unbilled revenue, tariff rates, alternative revenue programs, collectibility, accruals, and reconciliation of billing systems to the general ledger. Question 12. What is unbilled revenue, and how would you test it during month-end close? Unbilled revenue represents energy or gas delivered before customers are billed. To test it, I would understand the billing cycle cutoff, obtain consumption data through month-end, apply approved tariff rates, and review assumptions for customer classes and weather. I would compare the estimate with subsequent billings and prior period trends, investigate unusual movements, and ensure the accrual reverses or clears appropriately. Strong controls around data completeness and cutoff are essential because the balance directly affects reported revenue. Make sure to cover consumption after the last meter reading, estimation inputs, weather and usage trends, billing cycles, subsequent billings, cutoff, and analytical review against prior periods. Question 13. How do fuel and purchased power adjustment mechanisms affect accounting? Fuel and purchased power mechanisms allow a utility to pass certain cost changes through to customers rather than earning a margin on them. If actual qualifying costs exceed amounts collected, the difference may create a regulatory asset. If collections exceed costs, it may create a regulatory liability. I would reconcile actual fuel and power costs to approved recovery formulas, confirm eligible costs, and assess the timing of future rate adjustments or refunds. This prevents misclassifying pass-through activity as ordinary margin. In your answer, discuss pass-through costs, approved tariffs, timing differences, regulatory assets or liabilities, customer refunds, volatility management, and reconciliation of actual costs to collections. Question 14. How would you assess impairment of a utility asset or generating facility? I would begin by identifying indicators such as plant closure plans, declining demand, adverse regulation, sustained market price declines, or major cost overruns. Then I would apply the relevant U.S. generally accepted accounting principles model, compare carrying value with recoverable amounts or fair value as required, and document assumptions for generation, pricing, operating costs, and useful life. I would also consider whether regulatory recovery exists. An impairment is distinct from depreciation because it reflects a change in expected recoverability. Cover triggering events, recoverability, undiscounted cash flows where applicable, fair value, regulatory support, market conditions, useful life changes, and the distinction between impairment and normal depreciation. Question 15. What are the accounting implications of retiring or selling a utility plant? When plant is retired or sold, I would remove its gross cost and accumulated depreciation, record proceeds if applicable, and recognize the resulting gain or loss unless specific regulatory accounting applies. I would also account for removal costs, environmental obligations, and any remaining regulatory balance. If the asset is abandoned before service, impairment and regulatory recovery analysis may be required. The key is matching the accounting conclusion to the retirement event, regulatory order, and asset records. Discuss derecognition, accumulated depreciation, removal costs, proceeds, gain or loss, regulatory treatment, abandoned plant, and the importance of distinguishing an asset retirement from an asset impairment. Question 16. How would you account for environmental remediation obligations? I would recognize an environmental liability when remediation is probable and the cost can be reasonably estimated. The estimate would incorporate regulatory requirements, site assessments, contractor quotes, timing, inflation, and potentially discounting when appropriate. I would evaluate insurance recoveries separately and avoid offsetting them unless presentation requirements are satisfied. For a regulated entity, I would also determine whether approved customer recovery creates a regulatory asset. Estimates should be updated as investigations and regulatory negotiations develop. Be sure to mention probable and estimable liabilities, legal requirements, expected cash flows, discounting, insurance, regulatory recovery, revisions to estimates, and disclosure of significant uncertainty. Question 17. What key accounting issues arise from power purchase agreements? A power purchase agreement may be an executory supply contract, a lease, or contain a derivative, depending on its terms. I would assess whether an identified plant or capacity is controlled, whether payments are linked to market variables, and whether derivative scope exceptions apply. I would review dispatch rights, minimum purchase commitments, pricing formulas, renewable energy credits, and termination provisions. The accounting conclusion can affect recognition of right-of-use assets, liabilities, fair value changes, or future expense. Focus on lease versus supply contract analysis, identified assets, variable payments, derivatives, executory contracts, renewable energy attributes, delivery obligations, and the need to involve legal and valuation specialists. Question 18. How would you evaluate a lease for a utility company? I would determine whether the contract conveys control over the use of an identified asset for a period in exchange for consideration. For utility arrangements, that could involve office space, vehicles, land, transmission capacity, or equipment. I would assess renewal options, fixed and variable payments, discount rates, and non-lease components, then record the appropriate right-of-use asset and lease liability. I would also search contracts for embedded leases that procurement teams may have treated solely as service agreements. In your answer, cover identified assets, control of use, lease term, renewal options, payment components, right-of-use assets, lease liabilities, and separation of embedded leases from service arrangements. Question 19. Which balance sheet reconciliations are most important in a utility accounting close? I would prioritize accounts with large balances, significant judgment, or direct rate implications. Those include PP&E and CWIP, regulatory assets and liabilities, debt, eros, leases, customer receivables, fuel inventories, and deferred taxes. For each reconciliation, I would agree the subledger to the general ledger, investigate aged or unusual items, verify activity to source documents, and confirm roll-forward completeness. I would also review regulatory schedules because an unreconciled balance can affect both financial statements and future customer collections. Mention PP&E, construction work in progress, regulatory assets and liabilities, debt, eros, customer receivables, fuel inventories, leases, taxes, and reconciliation of subledgers to the general ledger. Question 20. How would you investigate an unexpected increase in operating expense during month-end close? I would first quantify the variance by account, business unit, and cost center, then compare it with budget, prior periods, weather, outages, and planned maintenance. I would inspect large journal entries, late invoices, accruals, reversals, reclassifications, and storm-related spending. Next, I would determine whether qualifying costs should be capitalized or deferred under regulatory accounting. Finally, I would validate the explanation with operational owners and document any correcting entry or recurring forecast implication. Focus on variance analysis, cutoff, accruals, reclassifications, storm activity, maintenance projects, payroll, vendor invoices, regulatory deferrals, and distinguishing a real business change from an accounting error. Question 21. What internal controls are especially important in utility accounting? I would emphasize controls over capital project authorization, procurement, asset placement in service, meter-to-bill completeness, regulatory accounting, and journal entries. Key controls include segregation of duties, system access reviews, approval of project changes, reconciliation of billing and asset subledgers, and documented review of estimates. Regulatory assets require evidence that recovery is authorized and probable. Effective controls should prevent errors and detect them promptly, with clear ownership, review evidence, and remediation when exceptions occur. Be sure to mention capital project approvals, meter-to-bill controls, journal entry review, regulatory order documentation, access controls, reconciliations, segregation of duties, and evidence supporting estimates. Question 22. How would you account for deferred income taxes at a regulated utility? Deferred taxes arise because book and tax recognition often differ, particularly when tax depreciation is faster than book depreciation. I would record deferred tax liabilities or assets for temporary differences, assess realizability of deferred tax assets, and consider enacted tax rate changes. For regulated utilities, normalization rules may require tax benefits to be passed to customers over the related recovery period, creating regulatory balances. I would reconcile the tax provision to returns, forecasts, and supporting temporary difference schedules. Discuss temporary differences, accelerated tax depreciation, deferred tax assets and liabilities, valuation allowances, normalization requirements, regulatory liabilities, and the effect of tax reform or rate changes. Question 23. How would you analyze Dominion Energy's cash flow statement? I would start with operating cash flow, separating recurring customer collections and supplier payments from working capital movements and regulatory timing differences. Investing cash flow would be dominated by capital expenditures, asset sales, or acquisitions, while financing reflects debt issuance, repayments, dividends, and equity activity. I would reconcile net income to cash, identify non-cash depreciation and regulatory amortization, and assess whether operating cash sustainably funds capital needs. That analysis links accounting results to liquidity and leverage. In your answer, cover operating cash flow, capital expenditures, financing activity, non-cash regulatory movements, working capital, debt issuance, dividends, and the difference between earnings and cash generation. Question 24. A regulator denies recovery of previously deferred storm costs. What accounting steps would you take? I would obtain and interpret the final regulatory order, then reassess whether future recovery remains probable. If recovery is no longer supported, I would write down or eliminate the regulatory asset in the period the conclusion changes, subject to applicable accounting guidance. I would evaluate related deferred taxes, disclose the effect if material, and explain the impact on earnings and forecasts. I would also review why the original estimate changed and strengthen monitoring controls for future regulatory decisions. Make sure to cover reassessing probability of recovery, regulatory asset impairment, write-off timing, evidence from the order, disclosure, tax effects, controls, and communication with auditors and management. Question 25. Why do you want to work in accounting at Dominion Energy, and how would you add value? Dominion Energy appeals to me because utility accounting connects financial reporting with essential infrastructure, regulation, investment, and customer outcomes. I would bring strong fundamentals in reconciliations, accruals, variance analysis, and internal controls, while learning the company's regulatory frameworks and systems quickly. In a close process, I add value by challenging unusual movements, documenting support clearly, and improving repeatable controls. I also communicate well with operational teams, which is critical when accounting depends on project status, usage data, and regulatory decisions. Focus on Dominion's regulated infrastructure, accounting complexity, public company discipline, analytical skills, control mindset, collaboration with operations and regulators, and a specific example of improving accuracy or efficiency. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.